A guy from SEBI just told me that the RBI is keeping the bond market overvalued and the retail investors like you and me are keeping the equity markets overvalued. I try to decode a classic example of financial repression in which the interest rates are kept exclusively low to boost consumption, to service the government debt, and the taxes are high. In this scenario, since the interest rates have been kept low for the past 1.5 years to 2 years, the pricing or the mark-to-market value of the fixed income securities are off the roof. We talk about a concept called as duration, which discusses the inverse relationship between the price of the fixed income securities and the yield commanded upon those fixed income securities. Since the yields are low, there is a huge mark-to-market gains in the books of the fixed income securities. Hence, it seems pricey. In case of equities, he meant was the valuations might seem fair. The valuations might be undervalued as well in some pockets, but overvalued as well in majority of the pockets. But the valuations need to be seen on a broader balance in terms of all the listed companies with the earning growth. In comparison with the earning growth, which is expected to be just 12-13% odd in the FY27 for India, the valuations seem exorbitantly high. The valuations still need to be corrected, but they will not correct. Fortunately or unfortunately, the valuations will not correct because of the limits being imposed by SEBI for the foreign investment. It's $7 billion for the MF and $1 billion for ETFs to invest into the foreign equity markets. If that limit gets opened up, the DII money or the retail money will start getting pulled out from the Indian equity markets and flow into the foreign markets, bringing down the prices as well as the valuations and making the Indian markets much more palatable, much more fairly valued or extremely undervalued. In that case, the FIIs or the FPIs might come back to invest again into the Indian markets. But again, I think that time has been delayed because if at this particular point of time, the Indian markets are facing so many issues from a micro level in terms of earnings, a macro shock as well, opening these limits can create a havoc. तो अच्छी बात है कि अभी वो लिमिट हम ओपन नहीं कर रहे हैं. On an average, over the past 30 years, India had been running a current account deficit of 2.5% odd, 2% to like 2.5% odd. In a couple of quarters, we had that come down to like 0.6% also. But on an average, India had been running a CAT of 2.6% odd. Fortunately, it was funded by a capital account surplus of 2.5% odd. And that's how the cycle works. And that's how the macro cycle works in terms of the current account and the capital account. A country running a current account deficit has to be funded by capital account. But unfortunately, in these scenarios, in the past 2 years or so, the capital account inflows have been negative to zero. Even if you see the FY26, so the gross FDI number has been closer to some $90 billion odd, but the net FDI has been negative to zero. So this time, the capital account surplus is not funding the current account deficit. Again, that's a problem. Second reason, the interest rate differential between the Indian markets and the US markets has historically been some 3.5% to 4% odd. A couple of quarters back, it came down to as low as 1.5%. It currently trades at somewhere closer to like 2%, 2.5% odd, but it came down to as low as 1.5%. So the interest rate differential is coming down. Then what will incentivize the FIIs to come back to India and invest into the Indian markets or the Indian fixed income securities when the interest rate differential is coming down? There is always a concept called as a covered interest rate parity, CIP. So this concept of covered interest rate parity simply states that if a currency is yielding a higher interest rate in the spot market, it should trade at a discount in the forward market to avoid any kind of arbitrary profits. In the context of India and US, India has always been yielding a higher interest rate versus the US markets. So hence the Indian currency used to trade or trades at a forward discount versus the USD currency. Hence the cost of hedging for importers has been high. But at this particular point of time, when the interest rate differential has come down, the INR is trading at a bit of a premium in the forward market, which is reducing the cost of hedging. Hence, the currency being undervalued is trading at a bit of premium in the forward market. Though, on a real effective exchange rate basis, the RER, the INR is still trading at an all-time discount, is trading at an undervaluation zone around some 92 or 93 ka level. It was as high as 106, 107 in September 2024. The currency has come down systematically. As of this particular point of time, the thing is we have been facing so many shocks from the macro side. The current account deficit, the oil shock, the trade deficit, right? The FPI's outflows, the currency getting sheerly undervalued, like closer to some 96, 97 levels as of now, right? So what should we do as of this particular point of time? Till September 2024, the micro picture was very strong, but the macro picture was weak. As of this particular juncture, the macro picture has become a problem for us, and the micro picture is still recovering. What's your view? Happy to know in the comment section. Thank you.